In today's tutorial, we're focusing on Fibonacci retracement levels, a powerful tool used by traders to identify potential support and resistance levels in the market. We'll focus on three key levels: the 618, 382, and the 0.5. What are Fibonacci retracement levels? Fibonacci retracement is a popular technical analysis tool that helps traders determine potential reversal levels by measuring the prior trend's movement. It's based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. The 0.618 level, often referred to as the golden ratio, is the most useful and significant level. It's widely used due to its frequent appearance in natural and financial phenomena. The 0.382 level, or 38.2%, is the most bullish Fibonacci level, indicating strong potential for trend continuation. The 0.5 level, or 50%, isn't derived from the Fibonacci sequence but is widely recognized for its psychological impact in the market, though it's not used as often. Here's an example. So we draw the fib from the low point to the highest point in the range. And as you can see, the price bounced off the 382 fib level. Here's another example. We draw the Fibonacci retracement from the lowest point to the highest point, and this time the price bounced off the 618 fib level. By using Fibonacci retracement alongside other strategies and indicators, you can accurately predict where the price is likely to bounce and continue its trend. Stay tuned for our upcoming videos, where we'll cover the most important tools and techniques in trading to help you achieve success.